This is Tom Aspray with the Viper Report Market Wrap video for the week ending March 20th. It was another tough week for investors and for traders as the market finished Friday on a weak note, suggesting we could have problems ahead. We'll get into today's report about whether there are signs or we should be worried about more than an intermediate correction. The bottom line is I don't see it at this point, but we'll review some of the evidence. And of course, the whole situation in the Gulf seems to be getting worse rather than better. I was concerned about that a couple of weeks ago, since the expertise in the current administration, in my view, was lacking. So let's look at what happened this week. So on the downside, gold got whacked. It's getting down to areas where I would expect us to see a short-term bottom. We're looking at the futures here in tomorrow's reports. Utilities down 5%, Dow down 2%, NASDAQ 100, New York Composite, and S&P all down about 2%. Russell did a little bit better, and the transportation were the bright spot, up 0.66%, which is based likely on more confidence in the economy. If you were to look at the monthly data, however, transports are down 10 for the month. Only worse is gold down 11.8, and the Nasdaq's down 4.4, Dow or S&P down 5.8, and the NYSE Composite down 7.8. Pretty rough. If you look down at our weekly table from the Viper ETF report, you can see that the close here was well below the pivots. IWM is the only one close, which is a negative sign, obviously. And if you look back also, you'll see that several markets, did close below their 20-week EMA. We don't see that often, certainly not since October of 22 when, the market made an important turn. More interesting is the weekly STARC Bands. We most of the market averages dropped below their STARC Bands last week, including the SPY. That is typically a sign that you're within a 1 to 2 week period of a pretty significant bounce or an end to the correction. So you can see that all the AD lines are now negative after last week's action. Above the 20-day, solidly 4%. So that allows for another couple of percent on the downside. Typically, if you get these in within 7 to 8%, you're not going to go a whole lot lower. So, for those who are short, I would be looking for another week open to take some profits, but still too early to buy. Above the 20-week, you can see that's also quite negative. We'll focus at first on the SPY, S&P. You can see the test of the STARC Band here. The next major support is this February 2025 high at 613.23. That's a little over 5% below where we are. We can see we're right back to the lows made last November. But down below, it's a good sign that the AD line is considerably higher. AD line was down here at that low, and we're quite a far behind it, with below the moving average, but above the uptrend here, and above the support from the buy signals last May. Volume was heavy, so that's not a great sign. If you look at the Qs, you can see it's actually still well above, its STARC Band. If you look down at its February high, 480.81, it's about 7.5% below where we are right now. Interesting, the retracement supports based on Fib, are a bit above that, 547.39, 50%, 519, and the STARC Band, as I said. So, right around in here we're almost back to the November lows. Down here, the AD line looks even stronger than prices. You can see the last time it dropped below its moving average, was right here, and the AD line has not dropped as much. So support to watch right here at that low, and then the uptrend here, does not look, typically a topping formation would be, a drop below that type of support, then a rebound back up to the moving average, which was flattened out or declining. That's still a possibility for us, but certainly too early to conclude that, in my opinion. Looking at the sector report from stock charts, you can see the financials did close higher. As I've mentioned for the past month or so, once this correction started, the financials were one that I was looking at just as a potential leader once this decline is over. So far, it's still potential, and when we get into the sectors, I'll show you why. I want to take a quick look back at this chart. You can see after in early 2025, we did drop below the STARC bands again. We had a couple of week stabilization, another wave of selling before we bottomed out. Don't know that we'll see that, but certainly when you get down to the lower STARC bands, you do remember it's a high risk place to sell and a low risk time to buy. The growth value ratio declined a bit, so it's still in a downtrend, sharply declining. MACDs are getting oversold, but doesn't seem like the value still seems to be leading. Looking at the NYSE, you can see it closed below the 20-week, also below the STARC band here, with support at 20,437, which is the pivot for the year. So that's an area I would expect to hold. You can see down here, though, the AD line has dropped back below its moving average. It's just testing this uptrend that goes all the way back to the late 23 October lows. This was when the market bottomed here, so we had the rally into 23, a pullback that scared a lot of people out, and then the AD lines flipped back to positive. So if you look at the NYSE all AD line, shows a very similar pattern. We're still above its uptrend, but below its moving average. So we'd look support at the high from late 24, and what's important, I think, is to notice that, we're still at 2160. The AD line, is well above the levels it was seen at the April lows, suggesting not as many stocks are contributing to the decline at this point. This is the bull bear. You can see bullish sentiment has dropped off. Could get even worse this week, but is getting down into the range where minus 30 used to be the benchmark. So there were 30% more bearish in the survey than bulls. Right now, we're at 22. So still definitely bearish. And I don't expect the news to get out of the war in the next week or so to encourage investors. You look at the daily charts, you don't really get excited on anything about a 2-day bounce or so. New York Composite, it's back into the support pretty good, but the AD line, the all AD line, shows a quite negative pattern here ever since it dropped below its moving average on March 5th. It's dropped back below these levels of support, and down below it, you can see the VIX is in early stages. It appears to be of an uptrend, so that's not a plus side for stocks. Frequently we've had more of a sharper rally, which has created less opportunities in the VIX than what we're seeing right now. Put call ratios got up above 1 middle of last week, dropped sharply, and are rebounding back, so still closed above 1. 1.15 in the indices. That's not surprising at all. So if you look at VXN, also volatility negative for stocks. This one is getting kind of interesting. So this is the percentage of stocks above the 20-day in the S&P, getting down to oversold reasons. You can see it got down even lower than that in April. Also, the 50-day is down to 20. So we got down below that. We got, I think 8 or something down here. And more concerning for a lot of people is the fact that the 200-day has dropped below this 50%. So, but historically, that would suggest that while some would say this is the start of a bear market, others would note that every time you've seen that sort of reading, we've got a pretty strong rally. This chart shows you that while the S&P 500 is down, to the November lows, the AD line is still much stronger. That bears watching. Typically that's been a strong signal for the intermediate to major trend. Shows you a little bit on the top about where the support is. We're coming in for the S&P 500 AD line, and still the AD numbers, which I find more important than the percentage of stocks above, say, the 200-day moving average, are holding up better. If you look below here in green, this is the number of stocks in the NASDAQ 100 above their 200-day moving average, which has dropped down to 40. April, of course, it was below 20. So we'll be watching this once we do see signs of a rally. So far, you're looking for straws for an immediate bounce. You can see 200-day here is also down in a downtrend, so we'll be watching it. High-low analysis, more new lows than highs. You can see here 447, though overall it suggests the stocks in the NASDAQ composite are holding up better currently. Of course, that doesn't have to last if things get worse in the Gulf. If you look at the NYSE, shows a pretty similar pattern here. It's made it above barely 203, so it's starting to kick into the area where you're seeing a sell signal, but you can see that with 41 new highs. If we look down at the QQQs, daily chart looks pretty ucky. We broke that support I've been worried about. So, that doesn't suggest, that it's other than oversold bounce. The relative performance, it bumped into this downtrend, and it's declining. If we look at the weekly, it doesn't look any better, though the AD line, you can draw support going way back to early 24. It has just broken that, but you can see where it is here. The last time the AD line was that low, we were probably lower than we are now. So weekly AD line, below its moving average and its broken support, doesn't show a consistent topping pattern. RS holding above its moving average. So if we can do that for another week or so, we might finally get a good rally in the Qs. MACDs suggest that rally will likely fail. I want to remind everyone, before we see a real end to the correction, obviously we need to see a new uptrend in the AD lines. So you can see this last high last week. That's going to be the first resistance level. You can sort of draw a downtrend here, but it looks like it's probably about early to do that. So, suggesting, our seatbelts will probably need to be fastened next week. And the NYSE ALD shows a similar pattern. So those of you that follow me around, you can see that, the AD lines, MAs are moving lower and declining. So they'll have to bottom out as well. A quick look at the watch list. This is the ETF report. You can see lots of new sell signals from XLRE, that's the REITs, to the utilities, to staples, to the consumer staples, silver, the REMX, that's another REIT, the AIU, as well as GLD. Not a lot of change here, still 45% widely skewed in terms of value, though it's still, it was up 90% I think last week. So you can see many of the value names, energy, etc., are holding up pretty well. No change in the short versus long. The signals, the DTS signals, are positive for those inverse ETFs, and they're negative for the long leveraged long ETF. Not a surprise. If you look at the sector report, we'll look at those charts, which are often the most interesting. So if we drill down here, expand this a little bit, showing a little bit percentage of stocks, or of stocks and ETFs above their quarterly pivots. Energy still looks strong. You have a couple little red in here, but not much. Materials actually is acting worse than this chart would say. So APG chemicals seems like they're holding up pretty well. Chart looks like it's still correcting 27%. So we usually like to see it above 50. Even worse for the industrials, which actually the chart looks stronger than the price behavior. So from market bull, that may be telling you something. However, if the for those of you who are scared to death of this market, that probably won't help. So consumer discretionary, also very weak. Though some people are looking at it too as an early, and I think that's where the DTS analysis, will come in very handy, because we'll be able to see, which ETFs are swinging the first. Staples, looking a little more toppy here, 0% positive, based on the 3D. Healthcare, 8.3%, pretty bad. Getting close to our stop. I'm sticking with it, and you can see the financials, looking a little friendly. It could break that downtrend without much problem. So stocks on that list are, just 1 hour: MasterCharge, American Express, Bank of America, JP, WFC, and MS looks one of the best. It's got a daily buy. Technology, only Intuit and AMD are looking pretty easy, but the chart suggests that it probably has bottomed, even though only 16.7%. So we'll be discussing XLK in tomorrow's reports. Communication is dropping down to test its moving average. Sort of a mixed bag here. So telephone came up with a daily buy and came up in some of the scans today. Utilities, lots of red, 8.3, and which is a shocker. Particularly if the market continues to move lower, I would expect both the XLU and the real estate to do better. Want to finish with this chart. Running short of time here. These are the global ETFs we've been talking about. You can see a couple of, Brazil, Thailand, and Taiwan are still showing positive weekly, negative weekly on the Wisdom Tree Japan and EWA. Over here, so pay attention to your STARC Band analysis. We always talk about after we've had a great run to the market, and now we're up near the plus bands, like a bunch of these were before this correction. You're looking at all these, there's a lot of ones that are quite oversold. So stay tuned, send me your feedback on this, and we'll try to keep you updated through the week. Even though some of you don't like Twitter, that's the easiest place for me to do it. Thank you very much for tuning in.